Hello, dear members. I welcome all the new members to this Facebook group. It's been quite a while since we have posted any videos. So I was working on few other things, and this is the topic on which I would like to briefly discuss today, just to give you a highlight on what it is. So it is the valuation of business. So, when we discuss about valuation of business, there are various ways in which the business is being valued. So, I'll be coming out on a separate video on about detail, explaining in detail on the various methods of valuation. But before that, I just wanted to share with you all on what are the various types of valuing a business, and just to give you an overview so that you will be prepared like what it is about. It is very important that the person who is valuing knows the purpose for which the business is to be valued, and the purpose for which the valuation is being used. So of course, based on the valuation, we are going to take some decisions. So depending on what is the need and the purpose for which the business is being valued, we are going to decide on the method for valuing the business. So there are generally there are three methods being discussed, but I would categorize as there are four approaches of calculating the value of the business. One is the income approach, the other is a cost approach, which is also called as the net assets approach. Okay, so that is the second approach. Third is um, cash flows, and the last is market approach. So these are the four approaches through which the business is being valued. Okay. What are the four ways of valuing the business? Those are: one is the income approach, the next is the cost approach, third is the cash flow approach, and the fourth is the market approach. So, in under each of these categories, we'll just briefly discuss on what it is all about. So, in the income approach, the business is being valued based on the income, that is nothing but the profits of the business. Based on the profits of the business, the it is being valued. And one method is known as the future maintainable profit method. Okay, so in this method, the past performance of the business is being valued. There is a post-tax profits of the earlier years are being averaged out, and that is being capitalized based on the discount rate or the rate of capitalization in order to arrive at the value of the business. So that is one method. The other one is based on the dividend, which is mainly it is the Gordon approach. Gordon dividend discounting model, Gordon approach of dividend discounting, in which the price is being calculated through a formula, which is where the price is equal to D1 divided by KE minus G. So this is the formula which is being used under the Gordon method. And a cost approach, it is the net assets of the business. Net assets means it is not just the balance sheet value, it is the sum of all the assets at after considering the current value of the business, current value of the assets. For example, if it is a fixed asset, then the current worth of the fixed asset is to be taken into account, not the historical value. After depreciation and any impairment, that value, then the current assets less the current liabilities. So after this, whatever, so the current assets, when we tell it is, we have to value each of it, say whether it is inventories or whether it is sundry debtors. So if it is a sundry debtors, then we need to provide for the bad debts, and sundry creditors. in case of liabilities. So all these, after considering all these, whatever the balance we get, this is nothing but the net assets, or it is also known as the net worth of the company. So this is one way of calculating the value of the business, which is the cost approach, through which we are valuing the net assets of the company. The third is the cash flow method, the famous and mostly utilized and most suitable and appropriate method, which is being used by the investors in order to choose whether to invest in a particular business. Like when I tell investors, it is mainly the in most cases of acquisitions, this method is being followed, which is nothing but the DCF method, which is known as discounted cash flow method. So in this method, the cash flow of the company is being calculated. So the free cash flow which is available for the firm is being arrived at in order to get to know about the free cash flow for the firm is being calculated, and this is being discounted at the rate which is usually the weighted average cost of capital. Weighted average, for arriving at the weighted average cost of capital, there is a formula. And even in this case, when it is dividend discount model, we need to be sure whether we are going to value the business, or whether we are going to value the uh, equity share, value the equity of the company. So depending on the purpose, we are going to arrive at the free cash flow, so for the firm, or free cash flows of the enterprise. If it is free cash flows for the equity, then we will use the cost of equity as the discounting factor. And under the market approach, this method is being used by all the investors, like in the share market. This is what is being widely used by all the investors in order to invest in the shares. Okay, so based on this market approach, the what is generally being used is the this formula, which is EPS into PE ratio. These are the four main methods, and I have just briefly explained on what is the value of the business. Hope to see you soon in a detailed video explaining all these methods with examples. Thank you.